Well, hello everyone. My name is Roger Scott. I'm the senior trader for Wealth Press. Today is Monday, June 8th. As you know, I still don't know where this month or where this year has gone. I'm still in February. I'm still thinking the market just fell off the cliff and it's just beginning to recover. But boy, oh boy, there's a lot of stuff going on, so let's get into it. Now, today's Monday, so I want to give you the week ahead and what you should be expecting. Let's start off with the news, and then I'll peel that onion for you and take every layer apart so you'll know exactly what to expect, so there's no surprises, all right? So, global stock market is mixed. The S&P is a little up, the Nasdaq's a little down. Momentum continues in some markets from a rally that began on Friday when the US government said employers added 2.5 million workers on their payroll. Economists were expecting instead to slash 8 million jobs. So this was huge. This was really, really big. Crude oil prices were steady after major oil production nations agreed over the weekend to extend a production cut of nearly 10 million barrels of oil a day through the end of July to counter the blow to demand from the COVID-19 pandemic. And I think that's going to have a big impact. The price of oil has risen last week on expectations of the move and lost some of the gains on Monday after OPEC officials did not commit to extending the cuts past July or establishing a way to enforce the production limits. Amid reports, the output in the U.S., which is not part of the cartel, was rising again. OPEC said the outlook remained uncertain. So again, we may see some upside in the crude oil market and in energy stocks based on that, especially with with the economy looking past COVID-19. The private sector spending was better than expected. Cabinet Office said, however, the first quarter came in before the Japan country fell full impact of a partial shutdown at home due to the nationwide state of emergency that has since been lifted. Massive central bank stimulus has helped spur gains in share prices driven by hopes that the economies will swiftly recover from the worst downturn in decades as the government relaxes lockdowns. Still, U.S. unemployment remains above 13%. That's not great. Nearly quadruple where it was at the start of the year and on par with its levels during the Great Depression. Biggest uncertainty, whether the virus will return, and tension between U.S. and China over trade wars. Those are the two biggest factors, believe it or not. So where do we stand right now? Well, let's start off with the calendar. There's not much data today. And tomorrow as well, we have FOMC meeting beginning. I don't know why I can't speak today. And then it's accumulating on Wednesday at 2:30 with the Fed chair press conference. And then we got jobless claims, and we don't have employment data, but we have consumer sentiment, which is pretty important. Especially right now, consumer sentiment is huge right now because that's a big factor driving the market. Remember, consumer sentiment makes up 2/3 of the GDP report. So that is very, very substantial. Now, all right, what should we expect from the market this week? How should we trade this market? Well, here's what I'm looking at. I'm looking at, and this usually is a very simple and a clean pattern. Whenever we have the FOMC minutes beginning, the market tends to calm down and cool off, and that tends to be the pattern till the end of the meeting. So I'm not expecting a lot of volatility at a lot of trading action come next 2 days. We should see volatility and volume increase as we get into Wednesday's report, the FOMC meeting and the Fed chair press conference. Those are going to be big reports, and I'm expecting a lot of volatility. But don't expect a lot of trading range and a lot of hedge funds to put in money prior to this report into the market. Even though the jobless data was solid, we don't know how it's going to wash out in terms of the GDP or the FOMC. And the FOMC is huge because the Fed's going to let us know whether they're going to lower rates or not. The expectations at this point is no lowering rates. I don't think the Fed wants to take anything negative, because if they take things negative, it's going to detract from money coming into this country, and I don't think the Fed wants to do that. Looking at the S&P 500, and this is the S&P 500, let me take away these studies here so you could see how this market looks without them. Let me just get rid of all this stuff here. So, as you could see here, The S&P has still not reached all-time highs. It's still lagging behind, but it's moving ahead. And if you look at the 200-day moving average, you will notice that we are strongly above. Now, here's the thing. If you look at the QQQ, you will notice that it's already making new highs. Now, here's the problem with that. I want to show you something interesting. If you look at the RSI, if you look at the relative strength index, you will notice that price is already higher here, but momentum levels are higher here. Notice the RSI is higher. Let me draw this for you. Lower. Look at this here. Higher. So price is moving higher, but momentum levels are not. Momentum levels are weakening. That's not a positive sign. Also, let me show you something else. These are the top sectors. If you look at the average, you will see the technology and consumer discretionary is leading. Now, notice materials now in third spot. Healthcare is now in fourth spot. That's not good. That's bad for the NASDAQ because the NASDAQ has a lot of healthcare, consumer discretionary, and technology. Material is not part of the NASDAQ 100. There's like maybe 3 material stocks in there, if that many. That's the S&P rearing its head. Industrial. Now, if you look over on a 1-month basis, look at what's leading. Industrial, energy, financial, material. Then you got consumer discretionary, and technology's not till 6th place. So you've got consumer discretionary and technology, and then real estate. It's all over the place on a 1-month basis, and that's because the blue chips have been recovering all those industries and the sectors that have been suppressed at the beginning of this recovery when March came and April came around, are now moving up. And that's telling me we're going to see a little change between the NASDAQ and the S&P. Because look, everything that led, like if you look at 3 months ago, look at this, technology, consumer discretionary, right? But not over the last month. Over the last month, industrial, energy, financial, materials, technologies in 6, let's see, 1, 2, 3, 4, 5, 6, 7th place. And consumer discretionary is in 5th. And notice they're not even next to each other. And that's a fragmented market. That's telling me that the NASDAQ, there's a few things that I look at. And one of them is when consumer discretionary and technology get out of being next to each other. When they get out of next to each other, that means the market is fragmented. It's out of whack. And when the market is out of whack, and we're seeing divergence like this, it's telling me that the NASDAQ is going to cool off. So what we've seen over the past few months, okay, with the NASDAQ and the tech leading and the blue chips lagging behind, I believe we're going to see a reversal or at least more comparable price action between the two. Let me show you internally what I mean. If you look at the market internally, and you look at the NASDAQ 100, you're going to see 95% of stocks trading above the 50-day moving average, all right? That's huge, huge, huge. But you're also going to see 83% stocks trading above the 200-day moving average. If you look at the S&P, you're going to see 96% of the stocks trading above the 50-day moving average, but only 55% of the stocks trading above the 200-day moving average. So 55% versus 83%. You see the difference there? That's big. So here's what I'm thinking. We have way too many stocks that are overpriced on a 50-day line. So, and we're seeing divergence on the NASDAQ. Therefore, what I'm going to expect is a pullback on the NASDAQ and the S&P, but more so on the tech stocks, giving these stocks, the industrial, energy, financial, and material, more strength at the expense of consumer discretionary, technology, and possibly healthcare. So you may see these sectors cool off a little bit while bluer chip stocks trade higher. And the reason I'm seeing is because the NASDAQ is just gone too far too fast. We're seeing divergence. We're seeing the RSI oscillator just totally giving us signals that are telling us the Nasdaq's overbought. We're seeing 95% of stocks above, but we're also seeing 83% above the 200-day moving average. And to give you some perspective, let me give you a long-term study. Notice these levels are getting up there, and unless we're going to extreme levels like we've seen here, over the last, let's see here, since 2013, we have not gone to these levels. So we're at nosebleed levels right now on the 200-day and the 50-day. So there's a really good, strong chance. Look at this. I mean, this is insane. This is the highest momentum levels on the Nasdaq in 20 years on a short-term basis. So there's a really good chance we're going to see a little weakness in the market, more so in the tech and consumer discretionary and less on the blue chips. Basically, we're going to undo a lot of what happened in the last 2 months. Not in terms of the market totally going down, but rebalancing itself. It's totally out of whack right now. A lot of it has to do with the strength of the downside. Look at this. It's like a rubber band exploding back up. But bottom line is that rubber band has now been stretched out, and it's being stretched out again in the opposite direction. So that's my analysis. Pay attention to it. These momentum levels are very important right now. I hope this gives you a really nice week ahead view of what to expect from the market. Now, I got something big for you. Everyone says you should just follow the smart money, right? Following smart money is smart. Now, sometimes it's easier to find and bet against bad trades. That's right. And that's why I'm teaming up, with Josh Martinez. He is awesome to show you exactly how to do that. And if you haven't seen Josh in action, his market timing is scary accurate, like scary accurate. Our smart money system doesn't care about the current crisis or coming recession. It identifies smart money spikes and allows you to trade with the backing of billions of dollars that's coming into Wall Street institutional money. You don't want to miss this. Josh Martinez and I together are scary accurate. Learn how to fade bad trades. Take losing traders and make them into your winning traders. This has the best edge I've seen in a very long time. Click the link below or follow the button at the end of this video. Folks, you don't want to miss this out. This is really cool. High percentage of accuracy. You don't want to miss out on this. I'll talk to you soon. Bye, guys.